A very good afternoon to all of you. Um, I'll start with our global outlook first. So, the global economy is currently facing two directly opposite forces at the moment. So, on the one hand, we have the rising COVID cases, and on the other hand, we have this urgency to roll out vaccines as soon as possible. So while the tunnel is dark and deep, but we surely believe that there is light at the end of it. Starting with the COVID cases have been rising in many parts of the world. If I talk about Europe, we expect things are likely to get worse before they get better. And on the other hand, the US is approaching record highs for COVID-19 death. When we talk about Asia, some countries in Asia are approaching normality, but the picture remains a lot more mixed in Latin American countries. And this is one of the reasons why there is a sense of urgency when it comes to vaccination rollouts. Vaccination rollouts have begun around the world, but then we also have to be cognizant of the divergences when it comes to access to vaccines, because the developing economies have brought much more vaccines than the emerging ones. And this divergence can actually be a little more pressing if the weaker and the poorer countries begin to report large number of COVID-19 cases. So this is something which we believe that we have to be a little more cognizant and are mindful of. Now, talking about recovery and reopening. So 2020 had a fair share of recovery. We saw the fourth quarter of 2020 had a decent recovery, and there are many factors which are going to impact recovery in 2021 as well. But the pace of vaccination is something which is likely to be the key when it comes to how recovery takes place. Starting with the good news first, the recent development around vaccination and the hope of a faster than expected normalization has kept the equity market buoyant. And this excitement can also be seen in the form of higher commodity prices. But then the not so good news is that many economies, and especially the ones around Europe and the US, ended 2020 on a softer footing. The rise in diseases led to certain restrictions in order to curb the disease spread, and as a result, activity momentum sort of faded in the fourth quarter of in Europe and the US, which is likely to show up at the start of 2021 as well. That said, the road to recovery may not be even for all the economies. It could actually vary depending upon the risks around the new variants of virus, disease penetration. Yeah. So, see, in terms of what are the risks which lie ahead in terms of the road to recovery, well, it could be a function of new variants of the virus. It could be a stronger COVID proliferation. It could be in the form of restrictions being imposed by the government to curb the disease spread. And then there are the positives also in the form of vaccination rollout, in the form of the vaccine being extremely effective in even in managing the existing virus as well as the new virus, etc. But that said, the road to recovery could be different for different economies. And just to put things into perspective, mainland China went into the pandemic at the very beginning and has touched the pre-pandemic levels in 2020 itself. Whereas the economy like India, which has started reporting strong activity momentum in the fourth quarter of 2020 and it continues to remain strong, there is an expectation that India would reach the pre-pandemic level hopefully by end 2021. But then we have economies like Italy, France, Spain, which are unlikely to touch 2019 levels even by end of 2022. And this divergence in the road to recovery will have an important bearing in terms of the global growth outlook. But before we go on to the global growth outlook, what are the different factors on which the recovery actually hinges on? Believe that there are these very important factors. The first one being consumer spending outlook. So consumer spending has been the driver of recovery in 2020, and it is likely to remain so in 2021 as well. But there will be a slight shift which we are expecting in 2021, because while a larger part of the previous recovery was led by consumer goods demand, there could services could actually play a little more important role in driving 2021's recovery, because once the vaccination comes into play, once the high touch services etc are begin to get offered a little more freely, which are currently under a lot of restrictions and control by the government, services demand could also begin to pick up, and that would help support the recovery then. But then services are also most vulnerable to the disease spread. We have already seen that the lockdowns, recently imposed lockdowns, actually showed up in the form of a drag, especially in the services sector, as we can see from the global sector PMI chart, that the ones which are actually at the worst of the media, transportation, consumer services, tourism, these are the high touch services which are sort of the most vulnerable when it comes to imposition of these lockdowns. The other very important factor which we believe can impact global recovery is how exactly is the labor market doing. See, as per our expectation, the extent of true damage to the labor market will not be visible until and unless these government sponsored support packages fade away. And this is one of the reasons why our economists believe that unemployment is likely to remain on a higher footing even in the first half of 2021 for a lot of countries. The third and the most important factor on which we believe global recovery is likely to be contingent is this huge wall of savings. So the lockdowns and the restrictions imposed during the pandemic level, where where the pandemic was at its peak, which is around March to June, that led to a huge mountain of savings with a lot of consumers. And this pot of savings is actually quite big. Just to give you some numbers, the aggregate household savings accrued in the US uh, since March is close to 1.9 trillion US dollars, and in case of Europe, it's somewhere around 480 billion euros. So the pace at which consumer spending picks up, that is also a function of how willing is the consumer to use a major part of their savings, which they have collected all during the pandemic period. And this, we believe, is likely to be an important driver in the recovery for 2021. So, talking a little more specifically in terms of growth outlook for US and for Europe, we believe US is likely to return the pre-pandemic level of GDP by end 2021. And if Biden manages to push even half of the planned fiscal stimulus, which is USD 1.9 trillion by end March, then this actually raises the prospects of reaching the pre-pandemic level a little more earlier. That said, when it comes to Europe, we do not really expect Europe to touch the 2019 levels anytime soon. I mean, by end 2022, and even when it comes to Europe, there will be divergence across the countries. So this is our overall outlook for US and Europe. In terms of numbers, we expect global growth to be somewhere around 4.8%, with risks obviously both on the upside and the downside, given the virus situation, the vaccine situation as a whole. But I would just want to caution you that when it comes to the numbers for US and the Eurozone, we need to be a little more cognizant, because the numbers could be misleading. I'll just elaborate a little more on that. So with respect to US, we are forecasting a 3.5% growth, while Eurozone, we are expecting a 4.7% growth. And this seems a little out of context, especially when I say that US is likely to touch the pre-pandemic by end this year, whereas Europe, I do not really see that happening in 2022. And this is because the level of contraction which we saw in Eurozone in 2020 is much bigger, which is around 7.6%, as opposed to a moderate contraction in US, which was around 3.4. So this is the reason I think instead of getting led by numbers, it's important to realize which economy touches the pre-pandemic level first. All right. With that, I turn towards the South Asian economies, starting with India first, as to how India is different in this entire framework of how the economies are doing across the world. So India is actually one of the very few countries which has managed to break the link between rising mobility and rising COVID cases. Despite a sharp rise in mobility led by festivals, pent up lockdown fatigue, pent up demand, we have not really seen a very sharp rise in COVID cases. In fact, India is actually on the in the fourth quadrant where mobility has been rising and change in daily new cases have actually fallen quite dramatically. And this is one of the reasons why India's growth has actually surprised on the upside with activity momentum being extremely strong, close to 96-97% of the pre-pandemic level. So FY22 is definitely going to be a strong year for India. But then part of this rebound will be explained by the base effects, as we are expecting a contraction of around 6.5% in FY21, which is the year ending March 21. And for next year, we are looking at a forecast of around 10 to 11% growth as per the official estimates. So 2022 definitely a strong year for India and aided further by vaccinations and a favorable base. But then, what kind of shifts are we expecting when it comes to growth in India? And this is where we believe that 2021 is actually going to be a year of rotations or shifts, as you would say. Some of these rotations would be very much organic in nature, while some of them may need some engineering done by the government. So I'll start with the rotations which are likely to be a little more organic in nature. Starting with obviously the demand, there is likely to be a rotation from goods to services. So that is our first expectation. So like as we can see in the chart, the left hand side chart actually shows how the demand for goods have already touched the pre-pandemic level, whereas services is still lingering somewhere around 30% below the pandemic level. And this is where we believe that 2020 would be more of a services story because, firstly, vaccination will come to our rescue. Secondly, the consumption pattern also supports the demand for services because this pandemic has not been this pandemic has had an unequal impact on the rich vis-a-vis a poor. So while the rich are getting a little more richer, their demand pattern also indicates that rich actually tend to consume a little more services. And this is where we believe that 2021 will see a shift from goods to services. The second shift which we are expecting is that from rural to urban. So back in 2020, COVID was actually a perfect storm for rural India. We had a little less stringent lockdowns in India. We had a lot of government spending, which was focused primarily on rural India. And then we had an excellent monsoon, which just supported agriculture, which is the main employment source in India for the rural India. So together, all of this actually shifted the headquarters of activity from the whole of into the rural area. And now when the economy is recovering and the laborers might want to migrate back to their urban jobs, we believe that this base of activity is likely to shift from the rural India to the urban India. So these are the two organic changes which we expect. The third change, the third rotation which we expect is likely to be from consumption to capex. And this is something which, in our understanding, will be engineered by the government because the Monday's budget for the year 2021 actually had a very strong capex thrust, which in itself indicates that yes, the government acknowledges that there have been scars in the economy because of the pandemic, and they are going to nudge the potential growth higher in the form by pushing up capital expenditure for India. On the other hand, if you look at the right hand side chart, it shows that how welfare spending and the rural thrust, which had sort of shot up in the year FY21, is likely to come off slightly, but then it's not going back dramatically. It still remains elevated, but the dire need of welfare spending because the economy is recovering and the disease control the disease spread is under control. We do not really need that much of a welfare spending. So this is when it comes to India. But then when we talk about, see, so far our discussion has been focused on the next 1 year, but there are but there are some long-term scars which could impact India's potential growth outlook, because we entered the pandemic with a weak financial system, with a risk-averse banking sector, which was not willing to take too much risk, and in the form of the credit growth being extremely slow. So these are some of the scars which can actually pull down India's potential growth from somewhere around 6% to 5%. And that is where we believe that the government initiative in the form of higher capex spending, in the form of coming up with production linked subsidies, give a boost to manufacturing and export activities, can actually help support and bring back our potential growth at least to 6% levels in the next few years. Now, talking about Sri Lanka, Shireen will be talking a lot more in detail, but I'll just highlight some of the near-term challenges for the economy. So, in terms of the most important challenge, definitely surviving the second wave of COVID, which is a lot more, which is of a much bigger proportion as compared to what Sri Lanka had seen in March and April. The second major challenge when it comes to Sri Lanka is reviving growth on a sustainable basis. And while 2021 growth is extremely contingent on vaccination rollout, we do expect Sri Lanka to grow somewhere around 7%, largely because of base effects. Because the main drivers of growth, which we believe are export, tourism, and investment, all these three factors may not be at their best in 2021, though we are a bit optimistic about tourism, especially in the fourth quarter, because by then a decent proportion of population across the world would have got some sort of a vaccine or maybe herd immunity. And definitely 4Q is the best time to visit Sri Lanka, and then there is a lot of lockdown related fatigue and pent up demand for tourism, which is likely to show up in Sri Lanka's tourism numbers for the fourth quarter. But beyond 2021, we're a little more worried about Sri Lanka's potential growth, because years of underinvestment has actually pulled down Sri Lanka's growth potential to around 3.5%. The sudden change in leadership in 2018, the bombings in 2019, the pandemic, all of this has really impacted the potential growth, which is likely to be somewhere around 3.5%. And that is something which really needs a lot of government support in terms of structural reforms. The third most important near-term challenge is in the form of managing this elevated fiscal deficit, which is projected to touch 8.9% as per the latest budget. And this does not sit very well with the long-term ambition of consolidating fiscal deficit to a 4%. So I believe there will be some bit of hard work which will be expected from the government, which is able to manage this twin goal of pushing growth higher, at the same time bringing the public debt level below. And lastly, and the most important risk which we see on the horizon, is that of debt sustainability. I think it's very important to acknowledge that the debt repayment pressure for Sri Lanka is not really a 1 year problem. It is going to remain the same for the next 5 years. So while the government is making arrangements in order to repay its near-term debt obligation, we believe that there is an urgent need to have some long-term solution which helps them roll forward their debt at a reasonable price on a long-term basis. Because until and unless this arrangement is done, every year Sri Lanka's economic outlook is likely to get clouded by these debt repayment concerns and uncertainties, which do have a negative impact on business sentiment, be it domestic investment or be it attracting FDI for pushing up the country's growth potential. With that, I hand it over to Shiran.
So our outlook for 2021, the theme that we generally go with the theme every year, and the theme which is, we felt quite apt, is twofold: driving growth. I think that's a key policy right now, and some of the slides that you will see in my presentation sort of highlights why growth needs to be trending up, and that's also policy priority as well. But also bridging deficits, and some of the deficits Ayushi sort of alluded to as well, but also some of the deficits or the gaps in some of our sectors, which really can once again be mended, and also that'll help in terms of driving growth as well. So that's our theme, and that's kind of where we're coming from in our Outlook report as well, and we will guide you through this presentation as well. So I'll just quickly do a quick global insight. Ayushi, I think, has covered very much in detail, but just a few points from our perspective. Then really go into the Sri Lanka macro insights, delve a little into our sector insights from the report, and then also just officially launch the report for on this webinar as well. So from a global growth perspective, as Ayushi mentioned, the positives are there. And clearly the numbers by the World Bank, the IMF are trending upwards, and a lot of it is driven by the vaccines. And it's very much higher than what we've had in the previous forecast as well. But if you look at whereas, for example, for emerging markets and developing economies, the growth is really being driven a lot um, by China. And if you sort of exclude this country's growth in this overall perspective, the growth number trends downwards to probably what it was 2018 pre-pandemic. So a lot of the other countries' recoveries are not too certain right now. And even with this positive growth outlook overall, if you look at it, there is still a lot of uncertainty. And if you look at where the World Uncertainty Index is right now, it's still very much above the average that has been there from about 1990 to about 2010. Still above it, even though a lot of the risks, some of the geopolitical risks have trimmed down. Still, the vaccine rollout, efficacy, all those factors are still not causing everyone to be too optimistic, and causing a little bit of cautious approach to it as well. From moving into what this means from Sri Lanka's economy, I think we've really seen very muted growth. We've not seen growth above 4% in a quarter since about 2016. The pandemic has really impacted growth as well. Third quarter, we did see a slight pickup, but as I alluded to, the outbreak, we'll sort of see the fourth quarter maybe not growing as much as what we did see in the third quarter. Overall, growth for 2020 coming down to maybe between -4 to -5% for the year. Across the key sectors of agriculture, industry, and services, we've seen a significant level of contraction. A lot of the factors driving this decline has been some industries like construction, transportation, apparel, and of course tourism, which doesn't have its own line item of its own, but is captured in sectors like accommodation and even transport to a certain extent as well. So a lot of these sectors really driving down growth in 2020. And from the household consumption point of view, which is another way to really look at GDP as well, we've seen an overall 5% decline in consumption during the first 9 months, and growth really being very much muted. And a lot of the policies, or at least getting growth back on track, will also be about getting a good feel-good factor back to the consumer. And some of the factors like the low interest rates level might determine a rebound in this factor as well. From what's going on with industry and services, really, because GDP does take a while to come out, one of the key indicators that we do track is the Purchasing Managers Index figure, which is globally recognized as well, and the central bank also puts this out very regularly, each month as well. And we've really seen, despite the two outbreaks taking place and the index falling below 50, which doesn't indicate that there is month-on-month expansion. We've seen post that really a pickup both in terms of the manufacturing and even the services PMI. Services less so because of the tourism impact as well. But we can really see the resilience in industry and the private sector overall with this as well. In terms of the regional growth outlook, why growth is also important and why Sri Lanka must aspire to go higher is also where the region is doing. So a lot of the other countries are expected to also rebound stage of V-shaped recovery, and that growth is expected to continue into 2022. Whereas some forecasts by, say, the World Bank sees it, coming off in 2022. So those that from a regional perspective, also it's really important that Sri Lanka really takes its growth trajectory forward. We do have some forecasts from other international forecasters as well. Some central bank, for example, at 6%. We can definitely get into this with Dr. Chandranath in the panel as well, but some of the others around 3% as well. Our base view is around 4 to 5% this year, which is coming from a contraction of about -4 to -5% as well. And a lot of the factors that drove the contraction will really turn positive. Factors like construction and consumption will do much better in 2021. From a growth perspective, looking at inflation, what we can really see is inflation being very much under control. Mid-single digit levels is what the central bank is also looking at. And really, the food supply factors really driving inflation, and the other factors sort of being very much muted. So food supply in 2021, how well the harvest is. Right now, the expectation, I think, for the March season is kind of an 8% fall compared to 2020. Will this have an impact on food supply, and therefore inflation is something to definitely watch out for as well. And of course, global oil prices and commodity prices, and whether that will have an impact on some of the administrated prices that we see for transport and fuel and the like. Given the low growth environment, we've really seen central bank being very proactive, cutting interest rates, providing an accommodative monetary policy. So rates have gone, from the lending rate, for example, gone from about 8% at the start of the year, the central bank lending rate, to about 5.5%, and a lot of other measures during the year as well, and that has really put downward pressure on interest rates, which have now sort of bottomed at about 5. If you look at the PLR, bottomed at around 5.8% levels as well. Why this low interest rate is taking place is because really there needs to be more credit taking place, more economic activity, and thereby more growth as well. And we can see that there is a slight uptick, there is a slight growth in overall credit to the private sector, but that is still far below what we've seen in the past, where we've seen in excess of 15% year on year in certain years as well. And the quality of, I think, the credit growth, which would matter more in really driving growth and ensuring it's sustainable as well. And as some of these figures show, some of what we have, the data so far shows where credit is going. Sectors like health, education, tourism, at least in the first half of the year, some of the growth were led by these sectors as well. But overall, I think from an interest rate point of view as well, I think the central bank will continue to be quite accommodative in the next 6 to 8 months, really until we see credit and overall economic activity to continue, and therefore we can really see this low level of interest rates maybe continuing for that period. Come 3Q and 4Q is where we might see a bit more of an uptick in rates once there has been this pickup in growth and credit growth as well. From an external point of view, if you look at some of the numbers, exports were down in the 11 months, but really from, I think, about May onwards, really showed a lot of resilience, showed a lot of recovery, and didn't ensure that, exports overall collapsed. Trade deficit down by about 25%, I think a 2 billion saving, which has really helped maintain a lower current account and overall BOP position as well, which was very much under pressure because of a lot of the debt refinancing that took place. Why sort of some of the other factors, or at least the debt side, is really important is where we are in terms of reserves. We're under 6 billion right now, and we really need to be improving this, because this is one indicator a lot of the foreign investors as well as the rating agencies do look at, and that has now come under. And I think expectation of swaps and some agreements like this will really help boost the reserve situation. Remittances, contrary to a lot of the expectation that we had early on, has really performed much better than expected, staged 6% recovery, with December, the last month of 2020, showing the highest monthly level of inflows during that month. And a lot of reasons, I think, primarily been driven by the fact that a lot of the remittances are now being captured through the formal channels as well, being a key reason for this. Um, Overall, because of the fact that we've not really seen the central bank going out and borrowing too much externally as well last year, using some of the reserves also to repay the debt, we've seen the external debt stock declining, at least in the first 3 quarters. And I think the shift to prioritize domestic debt is part of the strategy that we're really seeing taking place. And I think the numbers will also improve over time as we successfully roll over some of our debt. In the absence of these debt inflows, really the priority will have to be on FDIs. Understandably, with the pandemic, we really saw FDIs not doing too great this year. Last year in 2020, and that's something that will have to be put on priorities. Some of the key projects that have been talked about really will have to materialize during the year. But where else can we really get the inflow from? I think one area is the low level of foreign holdings in government securities. We've seen foreign holdings fall to under 10 billion. Now, this is something which was around 500 billion about 5 years back. And portfolio inflows right now for emerging markets are really favorable. We're seeing, I think, about 55 billion coming into emerging markets in January. Sri Lanka is yet to see the benefits of this, and this could be a real positive for the market, as well as be positive for the rupee as well, and maybe ease some of the debt concerns as well. But for this to take place, some of these funds really need to take a positive position. From the foreign inflow side of it, going straight into the rupee, really we've seen a lot of volatility, especially in the last 3-4 weeks. And I think the expectation is really these swings to really take place, where we have significant level of depreciation, followed by appreciation taking place as well. And that is really taking place because I think fueled partly by sentiment on the debt worries and partly on maybe some of the fundamentals also taking place as well. But overall, I think the business should really plan to or understand that there might be these swings, but overall, maybe the rupee could really be range bound between maybe 190 to 200 during the year, with significant swings, especially in the first half, as we look to settle the sovereign bond in July 2020. On the fiscal side of it, given some of the curtailment that we did see some of the tax revenue relief that we did see towards the end of 2019, plus a lot of the inactivity causing revenue also to sharply fall. So that's a trend which probably needs to be looked at in the year ahead. And from the foreign debt side of it, as Ayushi alluded to as well, we will continue to have to refinance about 4 billion excess of that in the next 5 years. So really, 2021 is the start of that journey to repaying this. And I think the policies put out by the government would now have to be sort of understood and taken forward to be able to comfortably repay this debt as well. What we did see from the budget as well is certain simplifications of purchase codes and the rates as well, with the customs duty, the CID being revised from its previous 3-band tier to 15, 10, and 5%. But what we really did see was, even though the 30% came down to 15%, as highlighted by some of these examples, we can really see new additions coming on in terms of cess. So overall, even though there was simplification, there was additions into the taxes as well. So from a net basis as well, we can see this might not really have too much of an impact on revenue. There's a target of about 180 billion as well. So a lot of these insights are captured in our report as well. And from a fiscal point of view as well, the targets, I think, really is to get to about 4% by 2025, and 2021 really should lay out the kind of the foundation for this growth as well, which with some of the economic activity raising revenue. Where is part of the growth also coming from? I think is through much more public investment. 2020, we saw really a curtailment to about 2.6% of GDP, really cutting down to meet the budget deficit targets as well. But that is expected to go to about 5.4%, which is in line with some of the other policies to develop roads, infrastructure, and overall construction as well. And the overall financing of the deficit is going to be coming through the domestic sources. So that's where sort of the pressure for interest rates, in particular, in the second half, might really come through and push upward on interest rates towards the second half is kind of is. So from the macro view, we look at the sectors. The report looks at all these sectors, from apparel to IT BPM to logistics, and to some of the agricultural sectors as well. And what we really see, I won't go too much into it, but we really see some of the macro themes playing out. The low interest rate, what does it mean for the consumer, what it means for sectors like FMCG and consumer durables, which is both from an opportunity for the consumer to really have been able to purchase more, to also companies also being able to maybe strengthen their local manufacturing capabilities as well. So twin objectives with the low interest rates taking place, and also the low interest rates also maybe facilitating the construction sector, which had been a key driver of growth, but now has really tapered off in the last few years. Could there be really more investment, more investments taking place with construction companies making use of the low interest rate level, and also consumers purchasing houses, apartments, and the like as well. From the import regulations point of view, this is something we consistently saw from April onwards with the Gazette almost each month. That uncertainty is something that might continue as the rupee comes under pressure. We might see really, this is one classic example, apparel really seeing a lot of changes, going from a temporary suspended list to credit days and going into an import control license. So really being able to prepare for this and being able to make sure that their supply chains are also ready for these kind of changes. And even though we did see import regulations taking place, we looked at kind of 15 items on food-related products, and what we really did see is, even despite import controls, temporary suspensions, overall, at least on a net basis for these 15 items, we did see a growth or increase in import value as well. So we're also seeing that despite controls, consumers are still purchasing, and then the companies are looking to still import with the restrictions in place as well. So the market is adapting to the changes. And the focus on some of the key sector reports, I think, sector projects, apparel, really developing the processing park in Eravur, the construction, as I mentioned, some of those key projects on the farmer side of the zone, and overall ICT BPM also a lot of allocations and mentions in the budget as well, and some of the other strategic projects such as the port city and the port terminals, and even the Hampatara port, looking at those. And really focusing on some of the new drivers. We've seen apparel, a lot of the agricultural products really driving our export growth, but this could be, or at least the pandemic could really put focus on some of the other sectors that are still below the radar, but can really punch above its weight to make sure Sri Lanka improves its overall export sector. And these are highlighted by these three sectors, ICT BPM, electronics, and as well as on the fishery side, shrimp and ornamental exports as well. So overall, what does this mean? For growth, V-shaped recovery is, I think, definitely expected. Growth between 4 to 5% is our base case. There is chances, in particular, if the second in the second half, for really a greater rebound, even a tourism-led rebound, which might see even growth becoming higher. But that's something very difficult to forecast at the current conditions. In terms of interest rates, really this low level of interest rates really continuing probably for the next 6 to 8 months, and then maybe a bit more pressure towards the end of the year. On the currency side, I think there will be a lot of volatility in it, purely on sentiment. But if you do really see some of the debt inflows coming in, some of the swaps coming in, some of the FDI that is planned coming in, and the exports really continuing its growth path and recovery path, I think the pressure on the LKR would also overall reduce. And I think these macro themes will really drive the sector growth. So with that, the team, myself and the team, the economic intelligence team of the chamber, we're proud to sort of release our report, and which is available for purchase on our website. If you go to the chamber website and go to publications, you'll definitely find this report as well.
Good afternoon, everyone. And first of all, let me congratulate Shiran and the team from EIU for compiling this very comprehensive report and putting it out. I know a lot of hard work went into that. And I also wish to thank all the sector specialists who have contributed with their ideas and perspectives. I must also add that these days, issuing an economic outlook is also a risky business because of the very volatile environment in which we operate. Last year, I think in 2020, February, we issued the outlook for 2020, but things changed so dramatically since then, so that I think it deviated quite a bit from the anticipated outlook. So let's look forward to a more stable, more predictable and less dramatic year, and hope that the economies will behave a little bit more like what we are expecting them to do at this point in time. So with that, let's get on to the panel discussion. So what I will do is, at the start, I'm going to ask each panelist, there is Dr. Chandranath Amalsekara, Amal Cabral, and Lakshini Fernando, to share their own perspective on how the global and local economies will perform in 2021. So we'll start off with a round, maybe if you can take about 5 minutes each. So can I invite Dr. Chandranath to start off?
Thank you very much. And it's great to see all of you. And let me also start by congratulating Shiran and the team for an excellent report, which we are all looking forward to read. I've seen a glimpse. I had a glimpse of it, glimpse of the presentation yesterday, and looking forward to reading it as well. So we had a couple of excellent presentations, and if I start with our own view about the how the Sri Lankan economy performed in 2020 and what we think could happen in 2021. And if I start with 2020, as Manjula said, we started with a lot of hope, but then we had 2 rounds of COVID. And because of the first round, the economy contracted by 16.3%. And there was again a very quick pickup in the third quarter. And we actually recorded the positive growth of 1.5% in the third quarter. And if you look at the quarter-on-quarter numbers, this 1.5% is similar to a more than 30% quarter-on-quarter growth in the third quarter. But unfortunately, then the second wave happened, and we now believe that the contraction in 2020 could be around 4%. 3.9% is the official projection at the moment. Could be around 4%. Depending on how the Department of Census and Statistics captures the impact of the second wave. What we saw was that by the second wave, the Sri Lankan economy, businesses and people, individuals were ready for COVID than in the first quarter, obviously, in the second quarter, the first wave. So because of that, we think that although there could have been some impact on growth in the fourth quarter, that would be much less than what we saw in the second quarter. So based on this around 4% contraction in 2020, we believe that our the current projections show that our growth, Sri Lanka's growth, could be around 6% in the year 2021. And we are glad to see that HSB is projecting a higher growth based on a greater contraction, of course, in 2020 for Sri Lanka. So that's what we see in terms of growth in 2021. And if you look at the measures that the government and the central bank has taken to stabilize the economy in 2020, we saw several fiscal measures being taken, several regulatory type of measures being taken, and also monetary policy measures being taken, in addition to the public health measures. And if I speak specifically about the monetary policy measures, because of the measures taken to reduce the policy interest rates and enhance liquidity in the market, we are now seeing the lowest levels of market interest rates. And for the first time in history, we think that the average weighted lending rate will decline to a single-digit level in a month or two. And the prime rate has already come down to the lowest levels in history, and so the other rates in the market. If you look at and we also see the impact of low interest rates. And if you take the last 5 years of 5 months of 2020, you see private sector credit growing by more than around 350 billion rupees. And we expect this trend to continue in 2021. And we believe that private sector credit growth in 2021 would be about 850 billion rupees. And the external sector, if I talk about the external sector of the economy, that had the most impact and that showed the greatest volatility with the COVID effect. And we saw exports declining. Exports, in fact, declined by about $2 billion US during the year. But because of the measures that the government and the central bank took, and because of the fuel prices, imports contracted by $4 billion. And because of that, we have seen an improvement in the trade balance in 2020. And in fact, although we saw a huge dip in tourism, we saw workers' remittances increasing, and all of these resulted in the current account by the third quarter of the year. So we are expecting a marginal deficit in the current account in 2020. And we saw, as Shiran mentioned, quite a bit of volatility in the forex market. The exchange rate almost hit 200 rupees in April. But since then, the exchange rate stabilized at about 185 levels until December. And in December, again, and also in January, we see a bit of volatility. And most of that volatility is because of the speculative behavior of the market. And we have taken several measures. And if volatility continues, we will take further steps to contain this volatility. And we ended the year 2020 with a reserve level of 5.7 billion US, and that was after the repayment of more than 4.5 billion of external debt service payments. And in 2021 also we have similar amount of 4.3 billion US of external debt service payments, and we are confident, and we can talk about it during the discussion if necessary, but we are confident that we can meet our external debt obligations without any problem in 2021 as well. And I'm not saying that everything is rosy, but the outlook could be brighter, and that's all I'm saying. And we also have we have already seen the domestic investors in particular becoming increasingly bullish about the Sri Lankan economy. And if the global economic conditions improve, and there are further improvements in domestic economic conditions, we believe that the foreign investors who were absent in 2020 would also become bullish about the Sri Lankan economy going forward. Again, I should add that we have already seen several signs of this materializing. So let me stop there, and we can continue later. Thank you.
And can I ask Lakshini also, as an economic analyst, what your views are on the likely turnout of things, again, both local and global, and thereafter we'll come to some more specific questions directed at all three of you.
Sure. And firstly, congratulations to the Chamber and the team for your Outlook report, and thank you for having me on the panel as well. I think both speakers earlier gave a very good overview on the outlook, but let me just give a bit more insight into where we see the economy going in 2021. Now, if you look at where the economy came in going into 21, we did have reserves which were, at covering just about 4.3 months of imports at about 5.6 billion. Relatively low, coming into a year where we have about 6 billion of repayments due. But on the other hand, one of the key positives we had was that the government did have a very first approach in terms of mitigating the impact of COVID in the first wave. And the fact that coming into 21, as early on as in January, the vaccines have been given out is a key positive. You're looking at, 2 years of somewhat stifled consumption, and 2021, in our view, is a year where you will see consumption-driven growth. As Dr. Chandranath also said, interest rates are at historical lows, and the government also has a very domestically driven growth agenda, which we see as a key positive for this year. And we do see the the industrial sector sort of recovering relatively faster than the services sector. Now, if you look at the overall economy, you do see, and I do admit that there are some concerns, especially on the external side of things. But what we expect is the low rate environment to really support that growth momentum. And it's also a positive to see that the central bank is also maintaining that view where it's a supportive type of agenda for this year. And on that basis, we do see accommodating monetary policy stance for the first half of the year at least. A couple of concerning things that, at least things that we would keep an eye out on for this year is inflation. First and foremost, last year, the government was in a position to really domestically refinance because inflation was low. Now, with the central bank expecting 14% of credit growth, we would be a bit cautious on a crowding out effect this year as credit growth increases, and we do expect credit growth to increase much higher than last year. We expect it at about 8 to 10% this year, relatively lower than the central bank's forecast. And that essentially will support the overall economy, and it's also a very positive sign to see that the central bank is targeting certain areas in the sectors, especially the micro, small, and medium-term enterprises, where you will see a higher momentum of growth this year. If you look at some of the external things, I mean, look, the IMF also in January in their Outlook report showed that they actually revised their global growth forecast upwards to 5.5% from about 5.2%, if I'm not mistaken, earlier. And it's a pretty upbeat sort of outlook that you're seeing. But what's important to remember here is that the global pickup will be quite diverse. You will see emerging markets perform better purely because of that the low base effect. But you will also see the more developed markets being in a position where they can actually implement corrective policies a bit more than the emerging markets. Now, you will see that in Sri Lanka as well, where fiscal policy is needed, and we do expect certain expansion in fiscal policy measures this year, but the developed world will be that much more accommodative in terms of their policy measures. And overall, in terms of the global environment, we do see and expect an accommodative environment in terms of policies for this year. And as Ayush also mentioned, if especially the US goes into a quantitative easing measure in the terms of the stimulus measures in the first quarter, that would actually be a key positive globally. But things to watch out for, in my point of view, is commodity prices. Because even for Sri Lanka, if despite the import controls, despite very low import demand and also low oil prices, the overall import bill was down only about 20%, which should have been a bit more of a decline than that, given the low oil prices. And the concern would be commodity prices on overall inflation as well. I mean, we expect inflation to be about on the lower side of the central bank's threshold, and we don't expect it to go over than 6%. But we do think that there would be inflationary pressure for 2021. And on the other hand, I think debt refinancing, like everyone has mentioned, is one of the key areas of concern, and an area where more clarity would actually be the need at the hour. Because it's not a new phenomenon that Sri Lanka has high an external debt liability. It's just that the transparency of how the refinancing schedule is one of the concerns that we have at this point. I'll leave it at that for now, and maybe we can get into anything later on.
Thanks, Lakshmi. I think you stopped at the point I wanted to begin my next question. So we will start a round of few specific questions, and I would appreciate very much if you can be brief, since we have quite a lot of audience questions also building up, and we can try and sort of get through as many of them as possible. So Chandranath, this one is for you. There are some concerns being expressed about the country's ability to meet the foreign currency debt obligations that are falling due during the next few years. So my question to you is there a reason to be apprehensive about this, or are there sufficient reasons to believe that the government will somehow honor these obligations without any problem, as it has always done in the past? Can we have your response to that?
Thank you. And before responding to that, if I can take a minute to say that when Lakshmi started talking about inflation, I also got a bit worried. But I think what she's trying to say is that if at all we will hit the upper bound of the 4 to 6% band that we are targeting, it could happen. But we think that inflation with the subdued aggregate demand conditions, inflation will be around the middle of this 4 to 6% band. But having said that, let's get to the business of debt servicing. And as I said at the beginning, we have around 4.3 billion of external debt servicing obligations of the government to be met in 2021. And right now, for the remainder of the year, it's less than $4 billion US. But let's be realistic. In the past, our model, the model that the governments have continued to follow, has been borrow to repay, and we should take the current conditions as a blessing in disguise. And now that particular model has changed. Now the government is talking about the improvement in the real economy, improvement in exports, improving the trade balance, and improving the current account balance, and have higher FDI. I mean, FDI, we have been talking about FDIs for a long time. So this seems to be the model of the government. And obviously, if this materializes, as Shiran said in his presentation, we have already seen some improvement in the debt profile of the country. This process will continue to happen. But looking at the issue will be with the near term. The medium term part will have to be based on improving real inflows to the country rather than debt inflows. But in the near term, with the rating downgrades and with the limited access to with the very high sovereign bond yields for Sri Lankan ISBs that we are seeing, we have limited access to the conventional capital markets. So this is the situation that we are working with. But if you look at what the country has done in 2020, you see that Sri Lanka has saved $4 billion US dollars, 3.9 billion US dollars to be exact, through import compression and obviously low oil prices. So if this can be done, and if the trade deficit can be curtailed to a little bit more, then I think the country can save a lot more. I'm sure there will be a lot of losers when this policy is continued. But this is, I would think of this as some necessary evil. And also, we have lined up, we have been talking about these in the past, but those discussions are continuing. We are talking to the People's Bank of China. We are talking to the Reserve Bank of India, and we are talking to the China Development Bank. And very soon, and from what we hear, we should have some good news from at least two of those agencies during the month of February. So that's about the near-term plans. But it is a difficult situation, and definitely the speculation that's going on in the market is not helping. And I would urge you to urge the businesses in particular to make use of the current domestic conducive environment to improve the domestic production economy, so that the impact of that will be reflected in the external sector, and with the increased inflows, we'll be able to meet the debt service repayments in the period ahead as well. And also, I should remind that if you take any year, I think in the slides that we saw projections for 2021 to 2025. But if you take the years 2020 as well as 2019, during those years also we have met external debt servicing of 4.5 billion US dollars annually as well. Thank you.
Thanks, Chandranath. So I think you have sort of set the stage for the next question, which I'm going to put to Amal. As a business leader, I'm sure you'll be able to clear the air on this particular matter, which is there appears to be many positive factors that should encourage significant investment to be made by the private sector. When you look at the environment today, interest rates are at record low levels. Currency is also relatively stable, though we have seen a bit of a dip in the current month. But when you take 2020, it has not depreciated a lot. And political stability, something which we worried about a lot in the past, is no longer a concern. But yet, we don't see private sector credit demand and investment spending picking up in a significant way. So what's missing in the equation, and what will trigger more action in 2021?
Thanks, Manjula. I think what's missing in the equation are two things at a very headline business level. One is business confidence, and the other is risk appetite. And these two factors are rooted in how fast the global and local uncertainties, which are many, recede. Now, this in turn is dependent on how successfully and how speedily the multiple health issues related to the pandemic are tackled to bring life back to normal or near normal, and in parallel, how well the economy is managed. So with the start of the vaccine deployments that we are seeing there are some early signs of business confidence increasing. Also, I think confidence will continue to grow as the country gradually overcomes the challenges from the COVID-19 issues. Of course, winning the economic battles will be more challenging, and certainly it will take more time. Also, I think as global and local economies begin to pick up, we will see winning businesses stepping out of comfort zones and displaying increased risk appetites. There will certainly be opportunities in the local market and in particular in the export markets. There will be prospects in the traditional markets in terms of exports, and certainly Sri Lanka has to and needs to look at sectors which the country has not participated in the past, and maybe this is a sort of a opportunity for the country to actually look seriously into new opportunities, because for decades we have basically been milking the same cows. Also, I think there will be new opportunities in the post-pandemic new normal, and this is both locally and globally. So businesses that I think are visionary, astute, agile, and risk averse, I think will secure for themselves profitable growth opportunities. To do so, I think embracing technology, particularly in the digital space, cost efficiency, improving productivity, and so on, will be keys to success. And also, I think resilience and patience in this climate will be virtues for businesses. I hope I've given a sort of a broad answer on your question, Manjula. So I'll pause at that.
Yes, thanks a lot, Amal. So let me post this one to Lakshini. It seems that everybody is expecting the economy to rebound in 2021, at least back to 2019 levels. Of course, there are different forecasts, some as low as 3%. Today we had one at 7%. So it's quite a wide range, but everyone basically expects the economy to bounce back. So in that context, which sectors do you think will drive that growth? So will it be the same sectors that were hardest hit in 2020, staging a recovery and as a result bringing back this growth? Or do you think there will be new emerging sectors that will come to the forefront? Can I have a view from you on that?
Sure. And I think first and foremost, I think it's undoubtedly we will surpass the 2019 growth levels, where we saw an average of, say, 3%. Given that we are coming from such a low base, we would see a higher growth momentum for 21 onwards. And to me, where I see, like I mentioned in my introductory comments, I think where I see growth coming from is a lot from the consumer sector. I see from the industrial sector, there will be a lot of subsectors that will really show this growth momentum, which is primarily driven by the government's domestic-driven agenda. So you're likely to see the manufacturing sector, given the current import controls that are now still ongoing in some of the key segments. You will see that higher domestic demand driving your construction sector, manufacturing sector, and to some extent towards the second half of the year, you are likely to see the financial sector pick up as well. Now, like some of the other panelists have also mentioned, for us to have this continued growth momentum, though, for the medium term, non-debt related FDIs are a crucial factor. It's a very good signal that the government is very serious about FDIs. They're talking about it a lot more. especially if you look at the port city, the Hambantota zone areas, they are looking at sort of attracting FDIs. And if that sort of momentum continues, there will be a medium-term positive growth momentum going from 21 onwards. But if you look at the shorter term, where you see this year and where things are right now, you will see that credit-driven demand really impacting. And I mean, look, if you look at the last 2 years as well, Mantula, you had a very sort of stifled consumer demand. It was very average. You will see that pick up if you look at things like the rural income holders as well. Last year, the paddy harvest exceeded even the agriculture department's forecast. And that essentially, one factor was that there is more focus on domestic agriculture. But in a medium term, you will see these steps that the government has taken to really support that growth. So you will see that agri sector getting a lot more prominence than what it may have had earlier. And if the corrective measures like, say, technology is implemented into these sectors, you will see the agri sector do that much better. With global growth picking up, especially in some of our key export partners, you will see that you will see the exports demand pick up as well. And that again will be a key positive in an area where you will see total growth being driven. But overall, this year, what I see is, I mean, look, if you look at last year, some of the sectors that were really hit was tourism. To me, airports opening is a good sign, but I feel that for it to actually come back to somewhat of a meaningful contribution to GDP, it will be towards the second half of the year. So in that sense, I don't see leisure really picking up as much as it really should. But I mean, you never know, right? If the vaccine rollout is sort of done much better and much faster, and there is sort of momentum, depending on what quarantine regulations would be, you may see tourism recover faster than what is expected at this point. But at this point of time, given the information available, I would think that it's in the second half of the year, anyway, given our season, that you will see tourism recover, and the subsectors that are connected with tourism as well. So overall, at this point, I think the construction sector will see significant improvement coming from a contraction last year. You will see the consumer sector, you will see the manufacturing sector do quite well this year.
So there are a couple of questions to Chandranath. I will read both questions so that you can respond one after the other. These are both from the audience. Do we understand the reasons behind higher worker remittances despite the number of returnees, and what is the likelihood of this continuing? So that is one question. And the second one is, how does CBSL expect to unwind the current holding of 736 billion LKR without impacting the market liquidity, market rates and growth? So can you take the first one on worker remittances and then come to the CBSL holdings?
Sure. Thank you very much for those two excellent questions. On the workers' remittances question, that was a puzzle for us as well when this recovery started happening, because just like all the others, we also predicted that there will be a dip in workers' remittances. But actually what has happened is a 6% growth in remittances, and during several months towards the end of the year, we have seen more than 20% year-on-year growth in workers' remittances. And during the month of December, there was a record high inflow of workers' remittances. So there can be several reasons. Our statistics department, the economic research, the central bank's statistics department did a survey some time ago about job losses of Sri Lankans working abroad, and we did not see very large numbers of job losses. So that could be one reason. And at the same time, we saw, just like in Sri Lanka, where people's savings increased, there could have been an increase in savings of workers abroad as well, because the spending avenues became limited during the year 2020 because of the COVID pandemic. That is another reason, and also I think this is discussed in the chat also, that the because of the impact of on their families in Sri Lanka, workers could have remitted a higher number of higher amount of foreign currency. In addition, I think because the informal channels were restricted during the year, we think that there could have been a higher inflow through formal channels during the year 2020. And with the airports opening up, again there is a bit of uncertainty about what could happen in 2021, and because of that, we think that it was a very timely intervention by the government to allow that 2 rupee additional payment for remittance inflows, and that should allow us to have a more than 7 billion of remittances in 2021. Our projection at the moment is 7.5 billion, and it could be close to it could be more than that, depending on the movement of global oil prices as well, because what we have seen is whenever there is a recovery in oil prices, our remittance inflows also increase. So that's about the first question on remittances. The second one was about the unwinding of central bank's treasury bill holdings. And as you have observed correctly, the central bank is currently holding a very large amount of treasury bills. But even in the past, whenever there has been a shortage of liquidity, what we have done is to purchase government securities even from the secondary market. So this process will continue, and in 2021 we will as discussed earlier, we want to maintain this easy monetary policy stance to support the domestic economy in the absence of inflationary pressures. So we will maintain a high level of liquidity, and if we cannot purchase treasury bills from the primary market, then the secondary market will be open for us to pump sufficient liquidity to the market. Thank you.
Thanks, Chandranath, for that very comprehensive response. Let me ask a couple of questions relating to the stock market from Lakshini, I think who's out of everyone here most associated with the stock market. The two questions are, one is, what is the rate of credit growth towards share purchases on the stock exchange? To what extent it's financed by credit? And also, what are the reasons for the sudden booming of the CSE? Is this an artificial creation or a true interpretation of real market conditions? A couple of tricky questions for you.
Yeah, absolutely. Let me take the second question first, actually. Why the sudden surge in the markets? Look, I mean, even last year, right, you saw, and like we mentioned, interest rates have been coming down significantly. And especially in December, we saw that a lot of deposits got matured, and then we saw that fund sort of coming into the market, because now you're looking at fixed deposits that are about 4.5% to 5% against inflation, which is at about 4%. And it makes very little sense in real terms to actually keep money in an FD at this point, right? And with the government stance of maintaining lower rates, I think there has been investors are seeking for alternate investment opportunities. And one thing that we have seen is that there have been a number of new investors who have come into the market. And there's a significant number of funds that are coming in. Foreigners, I mean, like everyone knows, have still been exiting. And there are a couple of reasons for this as well. I think one of the reasons is that they are sort of making their profits at this point. And another is our credit rating as well, because there are some foreign funds which cannot essentially invest in countries that are C-rated. But that being said, the positive for me is that all of that foreign selling was absorbed by locals. I must admit, I think the market went up much faster than it technically should have, which is why we saw some selling down yesterday as well. But the positive again was today it recovered as quickly as it went down. So I wouldn't say it's an overheated market. I think that there are investors who are seeking for investment opportunities. And if you look at some of our blue chip stocks, they're actually trading at very attractive levels. If you look at the region as well, Sri Lanka still looks very attractive where we are trading right now. And I mean, as it was widely shown in the news, we were one of the best best performing stock markets for the year so far. And I think the overall idea is that given that there are significantly low rates there, and given the limited investment vehicles in Sri Lanka, the equity market is looking very attractive. But that being said, one thing I would really want to say also is that one must really look at the fundamentals when investing in stocks, and not only talk about what is really what everyone else is talking about. I think it's very important to look at the fundamentals of certain stocks when looking at the market. Taking the second question, I wouldn't really know the exact amount, but there is a relative amount of credit that is fueling the market. But the good thing is that the CSE and the SEC are looking into this, which I think is needed. And with the proper regulations, I think it's something which is a long-term positive to ensure that the equity brokers are actually aware of the regulations that are in place. I may just stop at that at this point, Manjula.
Thanks, Lakshmi. I think we have covered most of the audience questions. So maybe I will just ask Amal for a couple of more views on what we have discussed so far. Any thoughts you would like to share on the market, or anything broadly within the ambit of what we discussed? Over to you, Amal.
No, I think we've exhausted the sort of ideas that been put on the table today. But that said, I think what is businesses have got to do is, I go back to the points I made, and to say that there will be lots of opportunities, and there are lots of opportunities. It is how one looks at it, looking at your both your ability to take those risks and the ability to fund and invest behind these. But to do so, you need to have your fundamentals ready in terms of your business acumen, the technology, productivities, your cost management, and of course your marketing prowess coming into play, be it local or export. So I think if we look at the glass as half full, obviously no one's going to move forward. So you need to be able to look at the optimistic view of the markets, and there are many signals towards that. And if you do so, and you do so in a sensible and structured manner, with all the fundamentals in place, with the interest rates as low as they are today, I think we should be able to move forward. I qualify this by saying, as long as the pandemic is managed well, both locally and globally, this is a great opportunity for businesses to not just build on what they have built over the years, but also to break out into new sectors and so on. Because clearly there are opportunities, and not even thought through opportunities of the past will come on now. Because the new normal post the pandemic will be a very different market. I mean, if you look at how people have behaved. I mean, there is e-browsing, e-buying, e-paying now. There is e-media consumption, remote working. I think the 9 to 5, 5 days a week coming to office, I think is on the wane, right? There'll be hybrid models, remote working. The supply chains are getting reinvented as we speak. The use of artificial intelligence, machine learning, all of those are coming into play, and Sri Lanka has the ability to ride this wave. But you need to be bold, you need to be visionary, and take some risks. And you mitigate the risks with having your fundamentals in place. So I think, despite all the difficulty, the issues that we have faced in the last year and a half, 2 years, opportunities are coming. In fact, they are already there. And the ones that are astute will pick those opportunities and run.
Thanks, Amal. So I think since we are kind of running out of time, I'll give one final opportunity to Shiran. There's one question which I think we had missed earlier regarding the impact of oil prices on the trade deficit. So if you can just briefly touch on that, plus conclude with some final comments, Shiran.
Sure. Thanks, Manjula. So I think what we've seen in 2020 was kind of like a 1.2 billion saving in reserves in the trade deficit purely from oil prices coming off, and we saw it even going down to about $20 a barrel. Now it's gone back to about $40 a barrel. What we could see if it goes inch higher to, I mean, it's almost at 60, and even beyond is really that saving reducing. So that 1.2 billion reduction might come down further, and we might spend maybe 500 to 600 million more in 2021 than we did in the previous year. It'll also one aspect also will be the demand side. For example, if we use more, if there's not enough demand, or the consumers spend less as well. On the dollar swaps, I think there was a couple of questions on it as well. I think those are key to really get it. We've been talking about it for a while, and I think Dr. Chandra said, it might finalize during the month of February. That's very key to really arrest kind of the sentiment as well, and ensure that at least in the short term, we're able to plug some of the debt gaps as well. Overall, I think really this year will be twofold, as our theme suggests, driving growth, but also really bridging these deficits, and some of the sector deficits, as Amal mentioned, will be really key to get things across as well.